This is the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Dianne Crocker with Manus Clancy. Our trusty moderator, Alyssa Lewis, is with me in Seattle, but she is wrapping up our roadshow. So, Manus, we're on our own again this week. I'm in the coffee capital of the U.S. I think I've had 2 quad lattes so far today, so I'm ready to go, Manus. It's the first week of May. The markets are still sending mixed signals. We've got stocks pushing toward record highs. We've got bond yields moving higher. The 10-year touched around 4.45 at one point this week. There's no clear resolution in the Middle East. And on the economic side, we got a solid headline with private payrolls up 109,000 in April, but the gains were uneven across sectors. So we're still kind of stuck in this low hire, low fire labor market. What are you seeing? What's on your mind, Manus?
It's interesting. I put out some research yesterday. You could probably find it on LinkedIn. And I talked about my current state of mind being that we are in a game of Jenga. And at the top of the pile of wood are 2 things right now. One is U.S. equities. We saw several new all-time highs this week for the NASDAQ and S&P 500. We were seeing stocks like SanDisk, Micron, Intel, AMD jumping in some cases 15 or 20% in one day. We are clearly in nosebleed territory when it comes to U.S. equities. We are bubblicious, you might say, at this point. You could say, I don't think we're in frothy territory in CRE, but I think you would say the same thing about CRE, that it is at the top of the Jenga pile, in that we've seen no slowdown in activity. Higher rates have not really made any dent in CMBS or CRE CLO issuance. The sales transaction activity that we are tracking every day remains elevated. Even deeply distressed segments of the market, like office, are clearing in big numbers. And you wouldn't know that one by one, the pieces of the tower are being pulled out beneath these 2 markets. So what do I mean by that? The pieces being pulled out. Piece number 1, we're dealing with still $100 per barrel oil. As you mentioned, the war in Iran still hasn't ended. The 10-year still uncomfortably close to that 450 level, and it bounces around quite a bit. Risk premiums wider than they were in February. Every week we seem to find another little piece of that wood being pulled out from the foundation, and yet at the top of this, undeterred right now, are U.S. equities and the commercial real estate market. So it's really hard to know what goes next. If we pull out one more thing, if we see a bad jobs report number on Friday, if we see a bad CPI number in a week or 2, if the shooting starts again in the Middle East, is that the peg in the Jenga game that causes the house of cards to topple or not? We can take comfort in the fact that CRE has been incredibly resilient over the last year and a half. Can stocks be the same? Hard to say.
I have to say, Manus, I love the Jenga analogy. It's very relevant, and it's sadly relevant. And so I'm on the road this week. We've done workshops with environmental consultants and environmental risk managers at banks in Chicago and Costa Mesa and here in Seattle this morning. And, I would say the sentiment is generally positive from the audience. Many largely agreed with a modestly optimistic forecast and report that their own clients, whether it's a lender or an investor, are moving forward. But, I heard from some that there's kind of a sense of getting things done now in case things get worse. Another sentiment that things are good now, but if the market tanks, it's going to tank hard. And that, is very consistent with the Jenga analogy. That came from John Salmon at Terracon. And there was also a sense that it feels truly odd to feel really good about the market, despite the fact that there is a lot of momentum and a lot of positive factors and certainly improvements over what we saw last year in terms of property listings and in terms of capital availability and all the things that we talk about on the pod, but that it feels really odd to feel good about that momentum when the tensions in the Middle East and the tensions in the broader macro environment are intensifying. And, as you said, like not knowing how much longer the conflict in Iran will last is really just kind of a black cloud hanging over anything that's forward thinking right now. And of course, the midterm elections are coming up too. So I think the pressure is really going to be on to resolve that conflict.
I couldn't agree more with your last point. I think that that gives people a lot of solace in the madness that we see going around us, that at some point the president will have to say, let's pull out here just to save his party from the midterms. If we're still fighting a war in September and October, I think the Republican Party will have a very rough go of it in November. So I do think that that is part of the calculus. And it's probably something that people in the markets are counting on, that this can't go on much longer and the president will have to kind of wrap this up, for lack of a better word, before too long. And let's hope that that's the case. There were a couple of positive headlines. You touched upon one. I want to expand upon this a little bit because we've seen some very contrarian things happen over the last year. One was the CRE resilience that came after Liberation Day last year. I think the resilience we've seen after the war in Iran has been contrary to people's expectations. I think the AI euphoria that we've seen over the last year has probably been bigger and more impactful than anything anybody could have imagined a year ago. And one of the similar contrarian measures we're looking at right now, and I'd love your thoughts about this, is starting about 6 months ago, the belief was look out below for the U.S. jobs market. But this week we got better than expected job creation from ADP and a JOLTS report that also showed surprisingly strong hiring and fewer job openings than expected, which is obviously beneficial for wages and beneficial for the U.S. worker, really running contrary to what everybody was expecting to happen with this new AI move. What's your takeaway here?
Well, I think, those make for good headlines, but if you peel back the layers of the onion, the jobs report is still very uneven. There are certain sectors that are performing very well and others that are still struggling. So I think that's one metric where the data is a mixed bag. While we want to believe that job postings are increasing, and they're going down in some sectors that are still continuing to struggle. On that front, with the folks that I'm talking to on the road this week, while they're feeling pretty good about the due diligence projects coming down the line, and on the lender side, loan originations and refis are up, it presents employment questions for them because they're looking to staff up because they have pipelines that are very, very busy. But going back to your Jenga analogy, if the market's fragile, if things cave in, they don't want to overhire now and be stuck down the road with having to lay people off. So that just speaks to, I think, how the market feels both busy but shaky at the same time, which is a really kind of uncomfortable place to be.
The wind is blowing in both directions. It seems very blustery right now. On the one hand, decent ADP jobs number, decent JOLTS number. On the other hand, we see the McDonald's CEO today come out and say buying at McDonald's seems to be softening a little bit. Planet Fitness dropping 30% today because I guess people are canceling their gym renewals to save a few bucks. And of course, we know that gasoline is over $7 a gallon in California and over $4 a barrel here in South Carolina, which is extremely high for this part of the country. So a lot of countervailing winds out there, and it's very hard to know what comes next. I will bring up one other headline that I really like this week, which has nothing to do with jobs at all, but it does talk about our industry. This comes from Commercial Mortgage Alert, and the headline was that CRE CLO issuance is outpacing CMBS issuance. And why did I pull that out as a headline, which is a positive one? I've mentioned this a few times in the last few months to our listeners that I had a nagging worry in the back of my mind that the PE problems they saw on the corporate side were going to metastasize and take a bite out of the CRE lending space for PE. That people would make the connection that if lending discipline was bad on the corporate side, it was probably equally bad on the CRE side, and that banks would pull their warehouse lines. This would lead to one of the pillars of CRE lending kind of faltering, that you would see buyers of properties, people who need refinancing, lose one of their big sources of financing in the process. And instead, what we're seeing is this market is chugging along without any interruption whatsoever. And I think that's a real positive for this market, that people see strength in CRE as opposed to weakness in corporate loan PE lending.
Mm-hmm. I will say that in my presentations this week, when I kind of mirrored a comment that you made last week, which is that we are assuming that the conflict in Iran is resolved soon, that we could really be seeing a busier second half and perhaps even a busier Q3 and Q4 than we've seen in a number of years. I did get smiles from the audience this week when I told people to take their vacations now, just in case that forecast pans out. And one of the things that I do believe is that we've mentioned this before too, that CRE is increasingly viewed as a safe haven. As things on the private credit side start to look more and more opaque and more risky, that commercial real estate emerges as a place of stability and visibility. These are properties that are concrete assets. They have tenants, they have income streams. They're physical structures that our environmental consulting clients can inspect, and they can look at the properties below it and around it so that risk can be underwritten with some certainty. And, the capital is there, to your point, whether it's CMBS or CLO or banks lending activity, markets are open, and they're all up. So commercial real estate is looking really attractive, compared to alternatives. So unless things crumble, we could be looking at a busier second half.
I'm going to take a quick detour here to discuss something that I think is just so cool. We talked about AI a moment ago and its impact. You've seen this from me, Dianne, before. You see some of the mad inventions that I play with now that I have access to AI. We have a wonderful team here that has set up an AI sandbox for us so we could play with all of our Lightbox data in one place, protecting it from going outside of Lightbox so that it doesn't get into the general OpenAI or Claude or Anthropic world. And it's an amazing journey that I've been able to go through over the last 6 weeks, playing with this data, loading it up, building my own tools. And one of the things I built here is a 90-day rolling activity of appraisals, environmental orders, and sales. So every day this gets updated. I can see how many sales there were by property type within each MSA, how many appraisals were done. And there's something about this view that is just really incredible, that it just underscores how much activity is in there. And I'm just kind of looking at it right now. And I look, in the last 90 days, there have been 136 sales of size in the Denver MSA alone. Of that, 31 were offices alone in Denver in just 90 days. And so when we talk about velocity, it just blows me away. When I look at the environmental map, even this was, the mind-boggling in numbers. We see more than 2,500 environmental orders taking place in Southern California since the beginning of the year. Talk about a market that is powering through a lot of noise right now without missing a beat. This really brings it to life for me.
Yeah, that's really cool. And it's such a great time to do that because the market is really differentiated. That's, one thing that I found as we pulled together market snapshots for this roadshow is that, the Charlotte market can look very different than Denver's market, or than Seattle, where I am today, or Costa Mesa. So pulling that data together would make a job much, much easier to see how a particular metro is performing versus another. And Manus, I want to say, while I've been on the tour bus this week, you made a headline. I saw you were in a story in The Real Deal about how the office market is closer to the end of the reckoning than the beginning. And you said that the headlines on CMBS delinquencies hitting a record is really just a sign that lenders are finally moving past the extend and pretend phase. So are you telling us we should be happy about the delinquencies because it's actually what the early stages of recovery look like?
Well, I do think that the way the cycle works for distress is you see delinquent loans go up enormously. The numerator surges. Sometimes the denominator sags as the better stuff gets paid off and all that's left is the non-performing stuff. And when you start to see that inflection point, when the numbers are coming down, it's when that numerator starts to be resolved. When things start to sell, losses are taken, properties are going through the deed in lieu process or the auction process. And I think we're there at this point. I know that periodically I'll put that thought out there on LinkedIn and some people will come back and say, no, we're really still only in the third inning or the fourth inning. And by the way, this reporting is by Rich Bachman. He and I go way back, a terrific reporter for The Real Deal. But look at these numbers that I'm going to rattle off in kind of short order in kind of really off the beaten path markets. In the Fayetteville, Arkansas region, 7 office sales since the beginning of the year. In Minneapolis, St. Paul, it's not off the beaten path. It's sizable, but it's a depressed market. 13 sales. I already mentioned 31 in Denver, 21 in the Phoenix area, 22 in San Francisco, 14 in Seattle. These are not one-offs. Even in a place like Syracuse, we've seen 11 office sales since the beginning of the year. In Buffalo, 6. This is a market that is incredibly transparent right now. People know what things are selling for in the office space. If you go back 3 years, people were scratching their head. Is San Francisco a $300 a square foot market? $350, $250, $175. At one time, it was $800. It finally settled on about a $325 per square foot market. We found our level in most of these places. Chicago, Minneapolis, Seattle, Philadelphia, Charlotte. We have so many comps in these areas that it's easy for buyers and sellers to get together and say, we know what fair price is, we know what our value is, and it's time to get a deal done.
Yeah, and I think that's why 2025 was such an important pivot point. That was the great price reset. And thanks to all the appraisers out there, for kind of helping that and giving investors a sign that, look, we think pricing in these metros have hit bottom and you can move forward with deals because there's more clarity. But being able to see that 90-day rolling MSA activity is really, really cool. I love that. And it's changing in real time and is a great way to kind of highlight that there are a lot of differences from metro to metro. I wanted to mention too, Manus, that BizNow had a great article this week, and it ties in with the MSA analysis that you just talked about. The reporter was Jared Shanky, who you and I both know, and it was about REITs, saying that the Sun Belt is really seeing kind of an office comeback narrative taking shape. And it'd be interesting to look at your data for Atlanta and office specifically, because he interviewed 2 REITs, Cousins and Piedmont, both seeing a real pickup in leasing activity, especially tied to companies that are relocating from higher tax states like California and New York. So there's an example for you, to look at metros like Atlanta and see if that kind of ground truths what Jared is reporting.
I think it is. The headlines are certainly there. I'm just looking at my data now, and it seems like there's been 8 sales of size just in the last 90 days in Atlanta. So that underscores the point you're making. But I didn't expect to go there in this podcast. We hadn't talked about this beforehand, but this Sunbelt revival or potential Sunbelt revival, you can't mention that, I don't think, without talking about what happened in New York over the last week or two, that the new mayor of New York City really came out hard with his proposal to tax apartments $5 million and above for people that use them as second homes. And he really personalized this. And I think we talked about this a little bit last week about he singled out the CEO of Citadel to say, this person bought this really expensive apartment. He should be paying more taxes on this. And he really personalized the issue. And this week, the commercial real estate market pushed back. The head of Citadel reacted with this and said, I am very happy taking my employees to Miami. Several others, including Stephen Roth, said, we don't have to be here in New York. We could pick other major cities to set up camp. And I do think that the mayor of New York is playing with fire here, that there's a way to raise tax revenue and there's a way to do it responsibly. I don't think singling out companies as bad guys is the way to do it. And I think if he continues that process, I think companies will get up and move. It's happened before. It can happen again. And I think the new mayor has to really be very careful here.
Yeah, I hadn't followed that this week, so that's interesting. It'll be interesting to see if he pulls back a little bit so that he doesn't trigger kind of a migration trend out of New York City and into other metros, maybe like Atlanta, to the point that Jared was making in his article. That's interesting.
There was a headline this week too, actually two. One, the mayor of Seattle taking a similar tack. She basically said, you want to go? Go, bye. And she was very flippant about it. And just a day or two later, Starbucks said that their next corporate headquarters with 2,000 employees is going to be down in Nashville, where the business climate is more favorable. It's tricky. I think these cities have very ambitious, progressive goals for education, for daycare, for dealing with various social issues, but they need the tax revenue, and demonizing commercial real estate executives or successful businesses probably is cutting off your nose to spite your face.
Yeah, agreed. It could backfire. And I mean, those 2 metros you mentioned, New York City and Seattle, those are high rent districts. So for Seattle or for Starbucks moving to Nashville, that's also a cheaper market. So it's almost like they're giving them a reason to leave.
Dianne, again, this week I get to play the role of Alyssa, so I get to tee you up for this week's data dive. We've painted a fairly rosy picture about CRE resilience in the first 15 minutes of this podcast. Did the data from April reinforce that argument, or did it go against us?
Well, Manus, before I reveal it, let's set the stage with a little perspective. So the CRE Activity Index in January was 111. It was a higher 121 in February and then 117 in March. So anyone who listened last week heard your prediction that with the Iran war dragging on and what you're starting to notice with a recent softness in the deal closings that your group tracks, that you wouldn't be surprised if the index dipped closer to January levels due to things like the higher Treasury and higher oil prices. But I have to say, Manus, in this case, I'm relieved that your prediction missed the mark because the index came in for April at 125. So that replaces February as the year's new high water mark. And it's our fourth month in the triple digits. A bit of a surprise to the upside, just like Golden Tempo and the Kentucky Derby last weekend.
It's really a remarkable number. I did think that in March, because the war's impact was not fully felt. The war started, of course, in late February. So deals that were in progress were hard to pull when oil prices shot up and when interest rates shot up. I thought that April would be a much better barometer of some caution. I did predict, I think, 112 as my reading. I thought we'd move slightly lower in our index, but stay, well into that triple digits. I am so pleasantly surprised to be wrong that we've hit a new all-time or post-2022 high at 125. And it's just evidence that the wheels of activity continue to churn in the CRE space, that as with May of 2025 after Liberation Day, we haven't even recognized the speed bump in CRE.
Right, exactly. And I should also mention, Manus, that the index has three components: the property listings, environmental due diligence, and lender demand for appraisals. And in April, two of those increased, but the lender demand for appraisals went down just a little bit. So it wasn't universally increasing, but the other two increased enough to push us to a high water mark. So May will certainly be a test of the durability of this and a sign of whether the market can stay in the triple digits for the fifth month.
This just reinforces for me my baseline scenario, which I know is more bullish than most people's, but my expectation that when the war ends, the CRE market is going to see a real surge in activity. It wouldn't shock me if we saw a 135 or a 145 number before the end of the year on the backs of this narrative. The war ends, and your Treasury back to 395, risk premiums compress, CRE gets the benefit of more allocation that would normally go to PE firms on the corporate side, and the Fed cutting because they feel like they have to because of PE's broader issues. I think that's my baseline case. And I think if those things come to pass, as Dianne said, you'll be wishing you took your vacation in May or June and not back-ended it in the latter half of the year, because I do think we will be very, very busy.
Mm-hmm. If the war ends.
If the war ends, there's the enormous 800-pound caveat that we sit in the room with.
So I'm in Seattle today, as I said, so my did you know is grounded here. I shared in this morning's workshop that in Q1, the number of property listings in our Lightbox Live broker platform in Seattle, property listings were up 30% year over year. And notably, that's the highest growth in the 6 cities that we visited in this roadshow tour. Charlotte was second with growth in listings of 14%. And, of course, listing properties for sale is the first kind of movement of the flywheel towards deal flow. So Seattle attendees should be happy that their metro is off to a strong start this year.
That's terrific news. I think we've seen strength really across the country in the listings. You mentioned it when you talked about the Lightbox Activity Index, that listings were up across the U.S. And, the more geographic diversity we see with strength, the more I feel good about my prediction for the second half of the year. This is not 2022, where it was really a tale of two markets, where we saw softening in the upper Midwest, in the upper Atlantic, the mid-Atlantic, and we saw incredible strength in the Southeast, the Southwest, Texas, et cetera, right? It really was a tale of two markets where people were expecting enormous demographic tailwinds in the South and demographic headwinds in the North. I think we're seeing a much more evenly spread out recovery here. I think we're seeing positive signs in that Chicago metro for multifamily. In the office space, we're seeing strength in New York and San Francisco, and more recently in Los Angeles in office leasing. So it feels like a more evenly distributed foundation than a couple of years ago.
So here's an idea for you. How about you do the Did You Know next week, and you go into that 90-day MSA rolling average tool that you created and give us like the 3 that are showing the most momentum.
That sounds great. I look forward to it.
All right, Manus, let's move into the headlines that caught your eye. I understand you have a couple leasing stories first.
We don't talk about leasing all that much other than the fact that we've been very forthcoming in the stories we've seen out of San Francisco and New York about AI-related leases with firms taking up 100,000 square feet and up of spaces in those two markets. I have 2 very interesting ones for old school tenants that hit the wire this week, which I thought were very encouraging. The first one from Washington, D.C., like many markets, that was hit heavily by firms downsizing their space or giving up space entirely due to work from home. Accounting firms, consulting firms, ad firms, all using less space. The headline this week, this one from Commercial Observer, White & Case taking nearly 200,000 square feet in Washington, D.C. That's the biggest lease in 2026 thus far. The law firm will be taking that space at 1701 Pennsylvania Avenue Northwest. So we love this type of headline, an old school type of tenant, not AI, committing 200,000 square feet in the DC area. Good for them. And in New York, in Lower Manhattan, at One Liberty, this is a Brookfield property. CRE Gottlieb, another law firm, renewed its lease for 20 years for nearly 500,000 square feet in Lower Manhattan. This caught my eye for several reasons. Number one, a lease of this size, they don't get signed every day, 500,000 square feet, an enormous lease. But Lower Manhattan also not the destination it was 20 years ago when all of Wall Street was in Lower Manhattan. A lot of firms, especially law firms, have gravitated in recent years to be closer to Midtown, to be closer to Grand Central Terminal, and or to Hudson Yards on the far west side of New York, that in some ways the Lower Manhattan region has been left behind. But here we have CRE Gottlieb renewing for nearly 500,000 square feet, a boon for New York City.
We were reminiscing at the workshop today about how it was just a year or so ago that the federal government was threatening to cancel office leases in DC, and how that would make the struggling office market down there struggle really even more. The one in DC office is really interesting to me. And I think, one thing we have to remember is that the office market is really bifurcated, so you do have attorneys. I mean, you have law firms, you have accounting firms looking for trophy assets for high-end space, and major tenants that are really making long-term commitments to premium buildings. And I think the best assets, whether it's in Lower Manhattan or DC, are starting to kind of separate themselves from the rest of the market. So if this trend continues, I think things will get really competitive with kind of the next tier down from those big, shiny office buildings.
I have to say that nothing gets me going more than a big lease being signed in the office space these days. It's been such a sad story for the last 4 or 5 years. I love that firms are voting with their pocketbooks, that they're asking people to come back to the office, that they're doing it in parts of cities or in cities that haven't had a lot of good news in recent years. And I do hope that this trend continues and it starts to move into other areas so that we're starting to see property appreciation for some of those A- or B+ offices that are not the top of the market, but are near the top of the market, that are itching for new tenants to come in and fill those spaces.
Right, exactly. And when you have folks coming into the office in our central business districts, it also helps the ancillary businesses. They're spending money at retail, they're spending money at restaurants. So for urban areas that have been struggling, the back to office trend and these upticks in office leasing that you just mentioned as great examples are really positive for our downtowns post-COVID.
I think that last point you made is an extraordinarily important one. And I hate to be redundant here, but I will be for a moment, that we talked before about mayors potentially running businesses out of town because of their rhetoric. The entire commercial real estate market is an ecosystem. And the point that you brought up, sometimes we forget about this, that when a law firm like Cleary Gottlieb renews and they have 2,000 people coming through Lower Manhattan every day or at least 3 days a week, that has an enormous impact on the restaurants, the bars, the people selling coffee out of trucks on the corners of Lower Manhattan, the people that run small businesses there, the sandwich shops, and all the more reason to be constructive in this dialogue, that we often lose sight of how dependent people at the lower end of the economic spectrum are on the vibrancy of a city, on the number of people that come in, how they spend their money, whether or not they're coming to the office or doing it from home. So I couldn't agree with your point more that this will help people at the lower end of the scale kind of make ends meet.
Nothing screams optimism, as you like to say, like putting shovels in the ground. So what do you have on the development front this week?
Just like with our index that you referred to before, which showed no slowdown in activity, the headlines we saw this week across the country in terms of people breaking soil, getting projects started, just didn't seem to slow down whatsoever. And I'll run through these in short order. In West Nashville, this comes from Real Estate Business Online, Crescent and Stockbridge Capital will be breaking ground on a new 277-unit apartment development in that area. In Phoenix, in the Sky Harbor Airport area, Lincoln is looking to convert an office to industrial. They have broke ground on that this week. That also from Real Estate Business Online. And giving that publication the hat trick, they reported that High Street and Tokyo are breaking ground on a new 280-unit apartment project in downtown Richardson. So if we thought that capital was drying up because of private equity problems, because of higher interest rates, because of concerns about $100 oil, you wouldn't see the headlines that we've been seeing in the last week. People would be finding it hard to get construction funding. The headlines would read, so-and-so pulls a project because they can't get financing, or borrowers pulling back on lending until war ends, things like that. Instead, we're seeing full steam ahead in so many different markets, votes of confidence, leaps of faith in the four corners of the U.S., and that's great to see. Two more I'll run out just to close out this segment. In Southern California, Tijon Ranch and Dido are moving forward on a new 500,000 square foot warehouse. The firms cited limited supply in Inland Empire for the reason that they want to build a new property in Kern County. That reporting there from The Real Deal. And lastly, going back to New York City, Alchemy Properties bought a vacant Tribeca parking garage. So this is kind of west side near Soho. They paid $57 million for a parking garage that they will turn into a new luxury condo at that site. So when you run through this, we have Richardson, Phoenix, Nashville, Southern California, Lower Manhattan, Washington, D.C., all with positive headlines in CRE this week. And I couldn't find a one negative headline to throw in there to even pour any cold water on our stories this week, Dianne.
Well, Manus, you're making our listeners feel a lot better about the market if they happen to be watching the news and getting depressed. Those are great stories. I'll add one more that trumps the development stories that you just highlighted. It's a big one. SpaceX is eyeing a new Texas site for a $55 billion manufacturing project. This was a story that caught my eye in Commercial Search by Claudio Tiganescu, and it could be, if they move forward with it, one of the largest manufacturing projects that they've ever seen. The first phase alone is $55 billion, and at full build-out, it could reach nearly $120 billion. The project is called TerraFab, and they want to produce enough chips to support 1 terawatt of computing power every year, which is about twice the current annual U.S. consumption. So the proposed site is near College Station, Texas. And the article noted that there's a broader ecosystem forming because Tesla is planning a 2 million square foot R&D facility in Austin that's tied to that effort. So a lot happening in Texas in terms of development.
Well, we're seeing the big and the small. We see that, which is ginormous by any measure. We talked last week about people putting mini data centers connected to their homes. I don't know if you saw that. Dianne with the reporting that people are going to use excess capacity to create little mini data centers attached next to their generator in their backyard. I'm not sure I'm a big fan of having a data center attached to the back of my house, but who knows? We'll have to see where that trend goes. We like to end our pods each week with a slice of life, so I thought I'd throw Dianne a curveball this week. Since we started at the top of the hour with the game reference, we talked about Jenga and how the market felt like a Jenga market right now with some of the foundations being pulled out piece by piece. I have to ask you, Dianne, either as a child or as a parent, did you have a favorite game that you like to play with your kids to keep them occupied, or one that you like to play with your parents to keep you occupied on a rainy day?
When I was little, we had a lot of games in our house. We had, Monopoly, Life. We had that card game, Uno, Scrabble. I have to say, I think the one that I played the most growing up, or at least the one that I remember the most, is Monopoly. And it's not necessarily a positive association because my brother was scrupulous. And he would always seem to be able to buy up a whole corner of the board. The Marvin Gardens yellow and Pennsylvania Ave was green. And he'd have that whole dastardly corner of the board just monopolized. But the worst thing that he did was he would hide $500 bills that he earned. He would hide them under the table so that he appeared to be poor. And then he would pull them out just when I thought that I had him.
I imagine this brother became very successful. Right? He knew how to game the system early on. I imagine that served him well later in life.
It did. It did for sure. How about you? What did you play when you were little?
Well, I was never at all a board game person. If it was raining, I was miserable because I wanted to be outside with my friends playing that, throw the ball up in the air and hit balls to each other and run to bases, kind of like the Sandlot type scene. So I was miserable if I had to play. But as a grandfather, I think the worst one of all, because I'm still very much in that same mode. I want to be at the playground. I want to be kicking a ball around with my grandkids. I want to play hide and seek and so forth. And the worst one for me is chutes and ladders. Because if you remember, you get really close to the end. And if you land on something, you slide all the way back to the beginning and the game has to start again. And for a guy that didn't want to be playing in the first place, who wanted to be outside with his grandkids playing tag or hide and seek or something else, that slide back to the beginning was the real oh no moment for me.
Yeah. And hopefully that won't be chutes and ladders won't be a good analogy for the commercial real estate market in the coming months either.
There we go.
All right. Well, with that, let's close, Manus. Thank you to our producers at Bruning Media. Be sure to join us each week as we break down CRE news and data in context. You can listen on all your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you all for listening and have a great weekend.
Let's go.